Good evening or good afternoon. I can never quite work out what time of day it is. Those of you who have had the pleasure of coming to these events before will understand the basic format. I'm going to be a bit more boring than normal, I'm afraid, and I'm going to be a bit longer than normal as well. But I'm going to go through the slides, and then I've got a couple of things I want to raise with you which are not covered with slides. So just to forewarn you, if you want to go out then, by all means do so. This slide shows the summary fund account as at the end of March 2015. As normal, it's been extracted from the audited accounts, which themselves can be found in the annual report. That is published on the authority's website. And if you want some nice, quiet, easy reading during the winter days, it's 220 pages long, so you enjoy every single one of them. The first thing to note is that contributions and transfers rose by 89 million to 321 million, whilst the benefits payable increased by 13 million to 249 million. After payments made to leavers of 123 million, there's an apparent shortfall between contributions received and payments made of 51 million. However, last year was not a particularly normal year, and there are two significant distortions which I need to explain to you later on. Of the 315 million received in contributions, 261 million came from the employers and 54 million from members, i.e. about 80% came from the fund employers. This compares to about 75% last time. This is a one-off, in so much as two of the district councils decided to make considerable lump sum deficit payments during the year. This amounted to 142 million out of their total of 231 million contributions. A couple of the other smaller employers also paid up front. This means, of course, that in future years those employers will not be making such payments. Of the benefits payable, 191 million was represented by pensions, with the balance being lump sum retirement and death benefits. The biggest increase was in pension payments, and the District Council's total benefits payable amounted to £188 million. One of the unusual factors last year relates to the amount paid out to and on account of leavers. Last year, the sum involved was 123 million compared to just 14 million the previous year. Now, that difference is explained by the forced bulk transfer out of the fund of those members who were employed in the probation service. As part of a national restructuring, the Ministry of Justice decided all probation employees who are eligible should be moved into a single fund, and that is being administered by Greater Manchester. Therefore, in December, we transferred out £114 million of cash, and the equivalent amount of liabilities was also transferred to Greater Manchester. How was the shortfall in expenses met? Well, you can see investments income was static at about 150 million, although the bulk of that came, as usual, from company dividends, 94 million. They fell slightly year on year. But other two biggest contributions came from bond interest of 26 million and property rents of 19 million. The change in the value of investments was once again positive, and that produced an increase of 636 million, with the largest improvements in value by far coming from equities, i.e. company shares, of 350 odd million and bonds of 130 million. Although the slide shows an increase in administrative and investment management costs, they actually fell. This number is shown after an increase in VIT liability of roughly £200,000. When you add up all these constituents, you can see there was a net increase in the net assets available for investment of 726 million. This means that at the year end, the closing net asset value was 6.28 billion compared to 5.51 billion a year earlier. Unfortunately, since the year end, the fund valuation has fallen, so at the end of September, the fund was valued at 5.87 billion. This slide shows the fund's investment return compared to its benchmark and the Consumer Price Index over 1, 3, 5 and 10 years. Last year, the fund slightly underperformed its benchmark, returning 14.2% compared to the benchmark of 14.4%. Actually, last year, the average local authority fund only produced 13.2%, so we are ahead of the average. Despite that minor hiccup, the fund is ahead of its benchmark over 3 and 10 years, during a period when the average local government fund has underperformed. Although in percentage terms the outperformance appears to be relatively small, just 0.1%, it actually equates to over £65 million of added value and a reduction of a deficit of £140 million. Sorry, I don't know what I did then. In terms of peer group, the fund ranks 13th over 10 years. Now, as I've emphasised in previous years, the fund's benchmark is customised to its own liability profile and is therefore unique to the fund. This fund has been relatively mature compared to other local government funds and as a consequence has more of its money in protection assets. Protection assets means bonds. And we mean bonds because bonds are usually less risky than equities and hopefully produce a steady income and are so therefore suitable for pension funds requiring predictable cash flows. When I talk about equities, I mean shares invested in companies, and when I talk about bonds, I mean fixed income instruments, which basically say you lend to a borrower a set amount of money, and over a given period of time, the borrower promises to pay you that money back, and in the interim, you get some interest as your reward. According to State Street, who are an independent firm of analysts, the average LGPS fund last year had roughly 17% or so in bonds. We had an allocation of roughly 21%. That reflects our slight increase in maturity. Although the difference is slight, one consequence is in the years when fund tends to perform relatively well in years when equities are weaker. The average UK equity performance last year was 6.3% last year. The average UK bond performance last year was 11.8%. Your fund returned 7.1 and 13.6 respectively, so we're ahead over both categories. This slide shows how the assets were held at the end of March. As you can see, the fund had roughly 6% in equities, with 21% in bonds, with a balance split between real estate and alternative assets. Of the latter alternative assets, 4.5% is in private equity and 2.3% is in liquid-orientated funds. Private equity is the asset class which usually provides finance to smaller and growing businesses, although it can also be used for large company buyouts and so on. Over time, the returns tend to be better from private equity than from listed companies. But because we're locked in as an investor, usually for 5 or 7 years, when we don't have access to that cash. This so-called illiquidity is an impediment when crises arise or when we need to raise cash. Therefore, it's prudent not to have too much invested in the asset class. However, last year we did benefit in very strong distributions from our private equity portfolio from investments made in earlier years, and we hope that this will continue to be the case. In other words, the decisions we made 7 or 8 years ago are now coming to fruition and throwing off cash. As I've already mentioned, the investments in bonds are intended to try and produce secure and steady and repeatable income. Now, unfortunately, while they are relatively safe instruments, they are vulnerable to inflation, and over time they should lose value. Therefore, in order to participate in economic growth, pension funds invest in equities, which are shares in listed companies or quoted on stock exchanges. Equities offer investors access to earnings growth and increasing dividends if the companies are successful. If they are not and they fail, then investors risk losing their capital. On the opposite side, it is rare for bond investors to lose capital, although issues can and occasionally do default. So as always, when determining your asset allocation, it's a question between risk and reward. The overseas equity, the equity split is basically 32% in UK and 68% in overseas companies. This is a wider overseas weighting than most funds have, but you also got to bear in mind that about 80% of the earnings of the UK's biggest 100 companies are produced overseas anyway. This slide shows the constituents of the FTSE 100 share index at the year end, the FTSE 100 being the biggest companies listed in London. As you can see, more than a fifth of the index is made up of companies involved in activities relating to exploration, processing and retailing of commodities. Banks and financial services account for a further 20%, so as an index it is remarkably skewed and is not wholly reflective of the UK's domestic economy. But that is our mainstream index and the one that we are measured against. This slide shows in greater detail how the overseas equity portfolio is invested. Over the longer term, we expect the Asian and emerging market economies to produce better returns than the more developed Western ones, but over the last few months that has not been the case. On the one hand, the developed markets have been buoyed up and artificially supported by unprecedented levels of central bank cash, known as QE in the UK, whilst on the other hand, the slowing down of growth in China has adversely affected all those countries that used to supply it with commodities and raw materials. Now, it's impossible to predict when those trends will reverse, but a potential turning point could be when the American Central Bank, the Federal Reserve, decides to increase interest rates. That has been predicted on more than one occasion this year. Nearly all the economists questioned thought it would happen in September. It might happen in December, or it might happen first quarter of next year. We don't know. But the closer it gets to a US presidential election, the less likely the Fed is to act. Now, Japan remains an enigma. The positive action taken by Prime Minister Abe to stimulate the economy through military measures has only been half successful so far, with inflation not yet taking off, even though the currency has been devalued. There are minor reforms taking place in corporate Japan, and it's certainly become more shareholder-friendly and aware, but those benefits have not yet really materialised in terms of share price performance. So although the fund has added to its positions, it remains underweight. What are the features of the financial year from an investor's perspective? Well, this slide shows what has happened to the yield an investor can receive on a 30-year bond issued by the UK government. As you can see, it has fallen dramatically since 1996. Over that period, the average yield was 4.5%. It is now just 2.5%. It's not just in the UK the bond yields have fallen. This slide shows how the income received on a 30-year US Treasury bond, a government bond, which has averaged 6.9% since 1980, is now returning just 2.9%. UK bank rate is set by the Bank of England and sets the tone for all of Britain's other short-term interest rates. This is the price of money. It has been at 0.5% for what seems like forever, but that's not the norm. 7 years ago, it was 4.5%, having dropped from 5.75% over the previous 12 months. Compared to history, 0.5% is by far the lowest official rate in over 300 years. Now, why do I mention this? It's not just of academic interest. A world of negative yields creates a highly unusual environment where you get money for nothing but risk for free. There might be a song there. In these circumstances, investors prefer to ensure the return of capital rather than return of capital. Sorry, they want the return of capital rather than return on capital. They are faced with fewer choices to achieve risk-free returns and more alternatives to deliberately get return-free risk. If the central banks do succeed in their strategies and the global economy does return to normal, we could be faced with substantial losses on government bonds. Given those average yields, you'd expect the yields to revert to where the norm has been, and that only means a significant capital loss. So mindful of the detrimental effects lower yields are having on the fund's deficit, but also well aware of the potential capital loss of an increase in yields to overall return, we pursued a strategy during the year of being relatively short in the time period we hold within the bonds. That proved to be expensive last year, but we still basically believe that is right. Given the interplay between central bank policies and their impact across asset classes, the fund continued to favour risk assets and remained underweight in bonds. Overseas equities continued to be favoured ahead of UK shares, with a bias towards American markets despite the strength of the dollar. During the year, we made some minor adjustments to the way we manage UK equities, and we made more significant ones to the corporate bond and alternative asset exposures. We introduced a new split between large and smaller companies in the UK to try and reduce volatility and increase income. Similarly, we revamped the corporate bond holdings by instigating a switch to a buy and hold mandate, which became effective in June this year. Within alternatives, we've also put more emphasis on credit funds with a view to seeking income from those markets where the banks are exiting because of their need to comply with tighter capital requirements and regulation. Now, the thinking behind all these initiatives is for us to try and enhance the income opportunities we can see without damaging or loosening our internal risk controls. The fund's commercial real estate portfolio performed well last year, although the overall property return suffered because the agricultural valuation was a bit disappointing and we had adverse currency moves on the European fund holdings. The fund's 5 most valuable commercial properties are illustrated on this slide. 2 of them are in central London office blocks, which reflect the very high values being reached in the capital at the moment. Queen Victoria Street, which is the first one on the left, is valued at 31 million. It's in the City of London and is a multi-tenancy building. Whilst the second one, Cavendon Street, as you can see, is in the shadow of the BT Tower. It's in the north area of Oxford Street, is occupied by a firm of civil engineers and is valued at about 20 million. The 2 retail properties cover the subsectors of High Street and out of town. The supermarket is let on an inflation-linked rent for nearly 30 years and is valued at 24 million, whilst the Milton Keynes shopping park is anchored by Dunelm Mill. It also has shops in the bedding, soft furnishing and tile retailing services. It's worth 26 million. The 5th holding is 2 blocks of student accommodation built by the fund in conjunction with a local developer in Sussex. The buildings were developed in 2 phases, with one being let to a local college and the other to Chichester University. Their combined value is 29 million. In conjunction with the West Yorkshire Pension Fund, we acquired a portfolio of property assets in the area. This slide illustrates 3 of the buildings. One of them is a hotel in Sheffield and the other 2 are offices in Doncaster and Rotherham, a combined value of some £14 million. I'm pleased to say that the fund received the Local Government Chronicle Investment Award for property at a ceremony in November last year. Although the fund's total market value has increased dramatically over time, it's not been a smooth ride. You can clearly see the effect of the financial crisis in this chart, and going forward, we are not expecting the same rate of growth. Clearly, there will be 1 or 2 knocks along the way, and as already indicated, the fund value has fallen since the year end. As you know, the fund had some deposits with Icelandic banks. Some £24,000 of the money is still held in Icelandic krona in Iceland, but the main sums outstanding relate to the London subsidiary banks and not to their parents. We are hopeful that we'll get everything back from the Heritage Bank, but I have to say the outlook is not so good regarding the KSF deposit. Some £800,000 is still outstanding from KSF, but we don't think we're going to get all that back. The funds management approach has not changed and remains one of delivering sound, cost-effective investment management in accordance with the long-term horizons and requirements of a fund. Whilst it's acknowledged that to be around for the long-term, near-term performance must also be strong, it has to be remembered that the skill lies not in being blown off course by patches of turbulence, but instead focusing upon meeting the needs and the liabilities of a fund. This slide, prepared independently by State Street, illustrates the dilemma that all funds are facing. The market returns of 2014-15 are shown here. Although North American and Japanese equities produced sterling-adjusted returns of 25% and 27% respectively, the third greatest return came from UK index-linked gilts. These are inflation-linked bonds issued by Her Majesty's government. The 20% return was phenomenal in historic terms. You think that was a good thing, and it is. But unfortunately, because it is bond yields which he actually uses when he calculates the cost of pension liabilities, that means they have outstripped what would otherwise be regarded as a very positive investment return. The fund deficit is therefore unlikely to have decreased by the time we come ready for the 26 valuation. We're already preparing for that, and I think Gary will touch upon that when he comes to the podium. Now, that has finished my basic slide presentation, but I thought I ought to just talk a bit about responsible investment and the funds and authorities' policies here. There's been a lot of coverage recently in the press about the possible consequences of climate change upon investment portfolios, and hence future pension returns. Now, understandably, much of the discussion has been emotive and also polarised, largely around the prospects for so-called fossil fuels, with some lobbyists arguing for funds to sell their holdings directly in any company involved in them. Clearly, people are entitled to express their opinions, and it's incumbent upon fund managers to take them seriously. But campaigners need to recognise that pension funds exist to pay pensions, and not simply a tool for a minority, albeit a vocal one, to use other people's money to effect policy change as they see fit. If we agree to ignore the fact that oil and gas are the raw materials for a diverse range of products, such as plastics, man-made textiles, toothpaste, adhesives, shampoos, etc., and concentrate upon the 50 to 70% of oil that goes towards transportation fuels, we need to understand that the modern world simply cannot function without energy. It is the engine of modern life. So the task facing investors is how to understand that and how to make sure that we are appropriately positioned to take advantages of the challenges and the changes that are taking place within the marketplace and the global economy. The world is not standing still. It seems to us that there are at least two major drivers influencing energy policy at the moment. The first is regulation and the need to address the possible consequences of climate change. And in doing so, we need to question the existing policies that support the current fossil fuel-based model. The second is technology and the ways in which advances are already altering traditional means of using power and fuel. On the demand side, efficiency gains can significantly reduce energy consumption. On the supply side, renewables are becoming much more financially competitive. And as investors, we must embrace and encourage such changes, supporting companies as they adapt and innovate through this period of transition. We have to stimulate the discussion about how our capital can be best deployed to benefit from building a sustainable energy regime. Now, the energy sector, particularly fossil fuels such as coal, oil and gas, is most at risk from these changing policies. The concept of stranded assets, i.e. reserves owned by listed companies which could not be used and burned if the policies to limit global warming to temperature increases of 2, 2.5 or 3 degrees centigrade are implemented, is a valid one. Notwithstanding the likelihood or otherwise of global policy success at the forthcoming Paris conference in December, it's interesting to note announcements being made by individual countries. China, for instance, long deemed to be the world's biggest polluter, has stated that it aims to reduce energy intensity by 40 to 45% and is under enormous social pressure to reduce pollution. In the United States, the threat of the Clean Power Act is already influencing the way power utilities operate. In India, the desire to increase its solar energy generation from 20 gigawatts to 100 gigawatts can be a true game changer for the industry. As important are the moves by global governments to reduce fossil fuel subsidies. Global governments spent $541 billion in subsidies in 2013. Most of that money was spent by developing countries as they improve the standards of living of their own people. Now, governments need cheap and accessible fuel sources for economic growth. A recent demonstration of how technology advances can influence real life has been how the ability to horizontally drill has opened up shale gas and oil deposits in the USA. The revolution significantly increased US domestic energy production, helping to push gas, oil and coal prices lower. In order to compete and not lose market share, OPEC then cut their own prices, and as a consequence, you've seen UK consumers benefiting from reduction in costs of the fuel pump. We need to say from the outset that there is no silver bullet to solve the energy and climate dilemma. Any solution will require numerous technological advances, some of which will need to be truly revolutionary and are way away on the horizon, whilst others are incremental and are being developed right now. For example, fridges now only use about a third of the electricity they used in 1990. In renewable energy generation, solar PV prices have fallen by 75% since 2009, and onshore wind is becoming competitive with traditional energy generation in many markets. Even in China, research suggests that wind will be cheaper than coal by 2022 and solar before 2028. The biggest stimulus, however, we believe, will come from the development of cheap and effective power storage capacity. Whilst batteries are continually improving, there is a long, long way to go before electric cars, for instance, become the norm. From an investor point of view, it is important to recognise that there is just as great a risk in investing in the new technologies as there is in holding on to the old, albeit a different sort of risk. Naturally, some of these solutions are costlier at the outset, and the risk of being too early into the wrong technology is a real one. Government manipulation of tariff regimes can dramatically make what was a profitable scheme into a costly mistake. Now, as mentioned, investing in PV in 2009 and seeing prices fall by 25% is not particularly what, as an investor in a manufacturer, you want to see. And if anybody doubts, remember the Betamax video. That went out of fashion very quickly. It's important to emphasise that fossil fuel will play a key part in our energy mix for many years to come, not least because developing countries want to aspire to the living standards the West currently enjoys. But faced with those trends, we do believe that the role of fossil fuels will reduce materially. As an owner of long-term assets, the fund clearly has a need to try and understand the implications of this energy transition. And there are broadly three ways we can do this. First, policy engagement. We believe that global and long-term issues require government intervention. These are global issues. However, individual institutional investors can contribute to the debate. We believe engagement at this level can only be done effectively through collective action. Our membership of groups such as the IIGCC, the Institutional Investor Group on Climate Change, which, by the way, we joined in 2004, helped to push for global European and UK policy changes to help build a low-carbon economy. If we weren't active shareholders, our authority involved in such participations would be much reduced. Company engagement. As a major shareholder, our engagement with companies is key. We take our responsibilities as investors seriously. Our direct and collaborative conversations increasingly focus upon the impact of future costs, to the business in the form of carbon tax, carbon price, profit costs, increasing research and investment needs. It also extends to effective sectors like energy, materials, auto transport and real estate, which need to establish resilient strategies but will withstand the burdens of these changes. Our role is to ensure the companies faced with this paradigm shift are having appropriate discussions at board level. We encourage them to demonstrate long-term strategies that embrace innovation and adequately communicate the business risks and opportunities to their shareholders. Your fund is proud to have co-filed shareholder resolutions to both the BP and Shell 2015 annual general meetings, stretching the companies over their reporting on climate risks. Both companies supported the resolutions and they were carried with 98% support. On the back of these successes, Swedish pension funds table a similar resolution as Statoil, and other resolutions have been heard at Chevron and Exxon meetings. Investment solutions. When the authority last reviewed its responsible investment strategy in September, it was agreed to conduct a fresh carbon audit. The last one had been carried out in 2009. It affirmed its policy of not directly investing in pure coal and tar sand companies and agreed that going forward, a long-term tilt towards a low-carbon economy should be explored. When looking at best how to achieve these goals, we have to be aware that with dwindling yields, the search for long-term stable returns might not necessarily be mutually compatible. Tackling climate change requires a joint effort between investors, policymakers, and companies. That conversation has barely begun. To participate and influence the conversation, we need to engage. Divesting out of companies does not provide engagement and, in our view, does not provide the solution. So that's a rundown on responsible investment. Before I go into the quiz, I need to also raise with you the spectre of government intervention in the way LGPS funds are invested. In his speech to the Conservative Party conference, the Chancellor said that they were planning to make the 89 English and Welsh LGPS funds put all their investments into what he called 6 or so sovereign wealth funds and increase investment in infrastructure. There is a lot of toing and throwing going on between government, i.e. CLG, the local government department, and the Treasury, and the funds as to what this exactly means. We have to bear in mind that your fund is very unusual in having an internally managed portfolio. People in Barnsley actually making decisions what to buy and sell. The majority of funds use external managers and they are expensive. Part of a Treasury remit is to cut those costs, and they are looking to achieve savings of anything between 200 to 400 million pounds, depending who you speak to. And their solution, blanket solution, is to bring all the funds down to a common denominator, rather than trying to improve the performance of the weakest funds by mentoring or by looking at best practice elsewhere. Their view seems to be that putting everybody into pools of 25 to 30 billion pounds is an easy solution. It should be cost effective because scale brings benefits, doesn't it? And it's also easier to invest in infrastructure if you do it that way. Our back of the envelope calculations suggest, given the latest data on the cost of running passive investment management, i.e. just replicating indices, your fund annual costs in investment terms will go up from about 950,000 to 3.5 million. Moreover, of course, you will not benefit from that outperformance we've generated over the last 10 years of 65 million or the deficit reduction of 140. We don't know what the final solution is. We don't know what government is going to say or do. All we are aware of is the Chancellor wants to say something in the budget statement in March. So watch this space. Clearly, from a self-preservation point of view, we want to keep as much of the status quo as possible. But I don't think that's going to be viable. So when you come here next year, I suspect you'll be facing a different investment regime. That is the so-called consultation. Right. So, possibly the highlight of this event, although I suspect that Gary's speech is going to take on that. There are two underlying themes to tonight's quiz. The first I've already touched upon, and that's the ongoing transfer of wealth to the Asian Pacific region away from the West. This is reflected in the growing urbanization of the global population and the growing emergence of the middle class. Whilst a lot of attention has been paid to the change in diet that accompanies greater wealth, such as eating more meat, eating more frequently, of course, and a greater number of dairy products, less has been made of the health advantages that city living rather than rural dwelling can bring. Simple things like abundant clean water and a predictable electricity supply translates into more fridges and fewer diseases. That means that people tend to live longer. And the second theme is just that. People around the world are living longer. The pensions industry globally and in the UK has tended to underestimate longevity. Now, just as we've been wrong-footed by the decline in bond yields, so we've underestimated the increased costs that longer life brings to pension funds. The shift in the demographics associated with more people living longer is, of course, dramatic. It also affects the number of people in the working population. For instance, it is estimated that in 2016, 20% of the UK's planned public spending will be on pensions. The state pension alone costs more than 90 billion, and spending on pensions generally will be 153 billion more than that on healthcare. Now, male longevity in the UK is now the same as that in Norway, whereas 30-odd years ago, we were 2 years behind. Female longevity in the UK is 3 years behind that of Japan, 2 years behind France, but is now on a par with Germany. Interestingly, the US, which has the world's most expensive and lavish healthcare system, routinely is found to be at the bottom of life expectancy tables amongst developed countries. Now, this quiz shows some slightly quirky questions about population trends, longevity, and wealth. This is a...
Before we get properly into the quiz, could we please just have one or two clarifications about each thing?
We're going to take questions at the end of the presentations. The world's great cities. This is the first question. Can you, from the list, please pick the answers to A and B? These are, of course, estimates that have been prepared by one of the major research houses. Watches. High-value wristwatches very closely reflect economic fortunes, and they plunge in price during periods of financial crisis. They did in 2008, 2009. But clearly, stock selection is very important. Which of those prices were achieved for that 1933 pocket watch? Which of those three brands of watches has seen the highest growth in sales in 2004? One of those gemstones has increased in value by 405% over the last 10 years. Can you tell me which one? Now, this information was found in the independent newspaper by a Swiss manager we talked to, and he pointed out quite gleefully that in the answer, Switzerland wasn't listed, and he was fairly sure that we never actually invaded Switzerland. So some of those numbers might be a bit dubious. But can you tell me which of those countries, according to this research, Britain has never got round to invading? Life expectancy today. I think that's self-explanatory. It says ONS statistics, as I've just mentioned, people are living longer. Can you tell me which of those years a female baby born between 2010 and 2012 can expect to live? along the same theme. And finally, in terms of quiz, UK population roughly 65 million. Can you tell me how many are now of state pension age or older? Thank you.